Welcome back to Golden Rule Radio, your weekly recap of the precious metals markets, and what a fun recap. All I can say is woo today. I've got Miles and Eric here as well, and we're just sitting here front row seat watching the price action. But before we get too deep into today, let's look at the week, Miles, if you'll give us a quick recap.
Yeah, let's take a little bit of a glance as to how the markets have moved this week. So we're looking at gold week to week since our last recording, up about 1.5%. At one point, it was up about 3%, and just giving $2,600 the gentlest kiss earlier today. So we'll certainly talk about the gold movement following on the heels of the FOMC here in a moment. A quick look at silver, up about 4.5%, but just like gold, almost about 9% move at one point, if you look at where we started and the high point in the middle. And it did hit over 31. And from my perspective, I think the most interesting fact here for silver is it did spend most of the week over 30. And I know 30 has been a bit of a fist fight. I'm actually sorry Rob's not here because he made some comments about 30 over the last few weeks. So platinum, about 1%, but a little bit more. Earlier this week, it was up over 4% at one point, and it is spending some time over $1,000 again. So it's nice to see platinum showing a little bit of strength, although not as much as palladium, which had been below platinum for a number of weeks. It has actually exceeded platinum, up about 4%. And over 11% at one point. So palladium actually had a pretty volatile week, and it is looking relatively strong, sitting $30 or so above platinum at this point. The S&P, not to be outdone, although a much bigger, slower moving ship, about 1.3% from our recording last week, about 2.5% at a high this week. And at one point, it did inch above the all-time highs in July. So we did at least put in an inter-day high, I believe, earlier today. And finally, as expected, with all that up movement, both in the precious metals and the equity markets, as you'd probably expect, the dollar index down about 0.2%, about 0.66%, was about 1.5% at one point, and it's bouncing the lows from last year, last December. So we are actually looking at the dollar putting in the lowest price for the year.
Yeah, just a ton of volatility with the Fed announcement today. Again, we'll do a deeper dive on that, but gold dropped 2% from that high right after that announcement. Eric, it's so great to have you back on. It's been a long time, and with Rob being sick, I'm excited to hear your take on the Federal Reserve announcement, but that's a huge drop from the peak. Most indices did the same thing. The dollar has an inverse move, which is pretty fascinating. We should just overlay the gold price action today with the dollar price action, or the US dollar index action today. And then silver, like you were saying, man, I mean, it dropped 4.5% after Powell's press conference, after having climbed 1% to just over that $31 figure. But I will say this, Miles, unfortunately, as we record now, platinum's back below 1,000. So it gave a little gasp and it's panting again. So we'll see what happens. But Eric, just give us your 2 cents. It's actually going to be about 25 cents on what the Fed did and how the markets reacted.
You bet. So don't want to get too caught up in short-term price action, especially on a Fed day. But really, the announcement came out. The Wall Street elites, if you will, got their cowbell. They got the 50 basis point cut. And, you know, there's this gap where 2 p.m. Eastern time, you get the FOMC announcement, and that's where we get the 50 basis point cut. But then there's this 30-minute window before Jay Powell starts talking. So right on the delivery of the news of 50 basis points, you had just about every asset spike. You saw gold put in the new all-time high, kissed 2,600, S&P put in a new all-time high. Silver, not anywhere near its all-time highs.
But over 31.
Over 31, but let's be real, right? Over 31 doesn't mean much because we saw 32.50 on, May 20th. So still lagging gold, which is why we saw that ratio that we tagged 72 to 1 on in May 20th get expanded back up to 90 to 1. As we sit today, I think we're right around 85 to 1. Regardless, you had big spike in all assets on the 50 basis points, knee-jerk reaction. And then Powell delivered what you could say was a little bit more of a hawkish presser. The thing that got everybody a little bit freaked out was him mentioning that the neutral rate was probably higher than they had originally thought. Now, that's just the rate that the Fed uses to set their monetary policy, whether it is restrictive or accommodative. That's the gauge that they're using. So him kind of saying that we might have been off on that throws everything off. If your baseline gauge was off, that changes things. And that was actually during the presser after his speech. You saw all assets reverse except for the dollar. Dollar found some footing, turned around and reversed. At the same time, gold went from up, I think like 1% on the day to almost down a full percent on the day. Silver reversed hard. And again, you said we touched the 31 level again, but for some reason that 29.72 level on silver has just been a magnet. It keeps coming back down to that level. And if we just zoom out on silver, you can see from April, kind of end of April, we broke above that $26 level and then got all the way up to 32.50 at the end of May. But we've been trading in this range for 5 months. Like
just chopping sideways, as you said.
Chop. And it's a wide chop.
You predicted a summer sideways chop, and that's exactly what's happened so far.
I did. I actually thought we would see that in gold as well. We were expecting the seasonal weakness, and I thought it would just be more chop, like a weaker chop, and gold did not. It's continued to be strong. And I mentioned to Miles earlier, my stance has kind of been I'm bullish gold, a little bearish silver. It's lagging. That's why the ratio is back up closer to 90. We're at a kind of a crossroads in the macro environment where we've been in this period of stagflation where you see gold do really well and all commodities do really well. Well, now we've seen the growth kind of shift a little bit more towards that deflationary cycle. And that's when we can get that ratio really stretched out because gold will act as a currency and silver falls into the commodities category. And we saw that kind of from the end of July up to present. If you just look at what has happened to copper, it's gotten hammered. If you look at what's happened to oil, it's gotten obliterated, right? Like commodities have gotten hit. Gold is currency, so it remains strong.
And that's coinciding with yields dropping.
Absolutely.
I don't know, I mean, if that's telling a story. And that sounds similar to what Rob was thinking last week as well. And so it's interesting to hear you say that. And Miles, I mean, in terms of this Fed announcement and everything, I know you often say, look, the charts are going to do what the charts are going to do. The news is just going to determine the rate at which it happens.
Sure.
And I don't know if you believe that too, Eric, but I'm the underlying fundamentals guy, and I'll get into some key fundamentals that have me bullish on gold. But Eric, you're exactly right that the ratios climbed to 89 here in the last few weeks. It's given a lot of that, well, some of that back as it went back down to 83. So we saw a 6-point reduction. And now today it popped 2 points just on that post-press conference type of action. We're right back up to 85 on the gold to silver ratio. And we'll get into some a little bit deeper in platinum and palladium. But Miles, in terms of that, I mean, did anything that happened today, even those short-term spikes, cause us to have a legitimate new high? Has anything changed for you predictively from a chart standpoint?
You said it yourself. For me, it's less about what's going to happen and more about what affects the timing and the duration that it takes for a trend to materialize itself. Let's start with the dollar. When I take a look at the dollar, I'm pretty firmly convinced that the US dollar is coming down even if they hadn't raised interest rates. You know, we had this conversation on the other side when interest rates were low and we were arguing about how much money are they going to pump into the system. I remember a couple of years ago, we were constantly having the, holy smokes, they put $85 billion into the system this month. And now they do that weekly. So it's not as big of a deal anymore. But it's the same sort of argument we used to have back then of the nitrous in the gas tank has like a diminishing effect over time. The addict gets less of a high each time. And I'm concerned that we're going to see that same type of effect here with the decreasing of interest rates. And my fear is we're in a buy the rumor, sell the news type of situation, but the trend isn't going to change. In that, we're going to get a little bump, but the trend isn't going to change. Or in gold, we're going to get a little bit of a decrease here maybe because we bought the rumor. The rumor was that we were looking at an interest rate decline of 1/4 point. And then here recently it came out that the interest rate expectation was more like 1/2 point, and it did end up being 1/2 point. So lo and behold, we had the rise in gold, we had the rise in equities, we had the rise in the stock market. We went up, we took out any standing orders that may have already been up there, any stop losses for anybody who might have shorts on the gold price, any profit taking over and above the previous highs. We took out any standing orders that were sitting around 2,600. That pushed the price back down temporarily. So for me, the question is just how long is it going to take for gold to find a little interim bottom here before we do start pushing to those new highs? Because Tori, this is where the ball gets passed over to you. Fundamentally, has anything changed? Like, great, they lowered interest rates and they're a little bit more hawkish than they had been. I don't buy it. I don't understand what the idea was behind doing it, at least not from an equity market standpoint.
You sound like Eric.
I sound like what?
Like Eric. No, we were talking before the show. The equity markets aside, okay, let's throw some theories out there. I mean, I've got some.
It's political.
Okay.
There's my theory.
Well, I agree with that. I mean, this will be bragged about by the current administration. This rate cut will be used for the campaign to say, see, the economy is actually doing well. They'll take choice words from the Fed chairman. And yet on the right, they're going to claim that it's election interference. So is the political conversation going to come out? Absolutely. But putting yourself in his shoes, because Miles, you have said, like, what a hard job. Eric, you have said, I'm not trying to put words in your guys' mouth, but each of you have said, look, really tough job, pretty good job so far, walking this tightrope that Powell has been walking the last couple of years, right? Mm-hmm. With balancing interest rates, with economic activity and everything else, the credit markets. But does it not support the dollar? We're right at the dollar support. So by him making the move, he's appeasing the banking system, which is still at high risk. He's appeasing the commercial real estate market, which is at very high risk. He's appeasing the federal government, whose debt service is going through the roof. So there are some winners with the rate cut, but can he, from the microphone afterwards, control inflation by being hawkish? So hawkish is you're in favor of rates staying higher longer. Dovish is you want lower rates. So he came out and made a dovish move, but spoke like a hawk. And that's what we're trying to figure out. Does it keep gold from running? Maybe that was part of it. Does it temper exuberance by him coming out? He keeps inflation and economic activity a little bit in check by tempering that exuberance. I don't know. I can see all of those being justifications. He didn't say. All that aside, what's next, Larkin?
I think the 50 basis points was to please, whether you want to say the elites or the political or whatever. But,
big money, yeah.
But really, that's not what he's supposed to be doing. And the bigger problem is we're just focusing on the impact that this has on the markets. But the truth of the matter is that us as the consumer, we still feel this inflation. We've seen the CPI number drop. And yes, certain things have come down in prices, but our everyday prices have maintained a high price. And by him now cutting rates, you're going to see a receleration of these inflationary assets. I don't see how that doesn't happen unless the Fed sees a slowdown in growth. And that would have made this more of an 50 cut, right? Like, things are slowing down.
Get ahead of it.
Exactly. So again, I wouldn't dare to try to be the one to interpret the Federal Reserve and the way that they speak. But I will tell you, it's just kind of more of the same. You can feel the distrust that the American people have in the system is palpable. I mean, every time they speak, you're just wondering how they got into this position. Yeah. And I think we're most likely seeing another policy mistake right here.
Okay, and aren't we also waiting? I mean, we all have to wait to see what happens with a recession. How do these interest rate cuts correlate to past recessions, for example? I mean, is he trying to stave off a recession? Is he admitting that maybe we're in one? Or is he saying there's not one in sight? I mean, I kind of heard all of that today.
Well, and that's one of the more confusing things, right? We got the GDP now numbers yesterday from the Atlanta Fed, and it's almost 3%. So that in itself, you would have thought would take 50 off the table. But here they did it. So it leads me to believe, and again, just my personal opinion, that it is more of a political move and they're pleasing somebody.
Yeah. All right. Well, I've got two underlying fundamentals that I'm going to focus on in terms of, Miles, your theory on a continuation of the gold trend, okay? Because you just touched on one of them, Larkin, a little bit. And for the sake of time, I'll fly through this. But one is the consumer credit and debt markets, okay? Both of those are skyrocketing. And then obviously the federal debt and spending is skyrocketing. So nothing's changed in that regard. All right. So it is convenient to see some interest rate cuts for the consumer and for the government, like I was saying. But that could actually backfire on the Fed and reignite inflation. Because why are they trying to make the credit markets easier, cheaper? I don't understand, because the total consumer debt doubled in the last 14 years. It rose by almost $15 billion in July, you guys. And now it's only $2 billion below the all-time high of $3.73 trillion that we set in January. So it's climbing again. That's total consumer debt. Total consumer credit jumped $25.5 billion in July, and it's at an all-time high of $5.1 trillion. These are scary numbers because credit card delinquencies are soaring. That's part of that to 9.1%. That's the highest level in 12 years. And the revolving debt, which includes credit card debt, rose $10.6 billion in July and hit a new record of $1.4 trillion. That debt tower is crumbling. We're seeing signs of it, right? Whether they cut rates 50 basis points or not, it's almost meaningless. It doesn't help the day-to-day consumer. It doesn't help me and you. It's helping the bigger money, like you're saying, and it's helping politicians. But the federal debt, yeah, they've got this stopgap spending bill going, but David pointed out in our staff meeting, $381 billion deficit in August. That's $80 billion higher than expected. So now our interest payments exceed $1 trillion. We're now officially paying $1 trillion a year just in interest on the federal debt. And now it's expected to hit $1.14 trillion by the end of this fiscal year, which is the end of this month. So we'll see that these are the real numbers. And yet you lower interest rates, you make it cheaper to borrow, and you're perpetuating that problem, which to me is the major underlying fundamental, not just for gold, but for the viability of our economy and our country. Anyway, Miles, we kind of derailed from charts for a while here, and I want to circle back to the white metals so that you have a chance to put these back up and give us your recap on silver, platinum, and palladium, because you talked about palladium outperforming platinum, and I don't want to leave the show without you touching on that.
Sure. Hey, just for fun, total revenue for the United States in 2024, $4.39 trillion, they're estimating, since fiscal year's coming to a close soon. So at $1 trillion a year in interest payments and rising, we're now at the point where we're paying a quarter of our national income just on interest. So I'm just curious, as an average consumer, talking about these interest rate movements, half a point up and down, as an average consumer, if you're already sitting at 25% of your paycheck is going to taxes, and then the next 25% is going to credit card debt, how much is that 50% a year leaving you to spend? So yeah, we're in trouble. And lowering interest rates, screaming, I'm hawkish, stop spending money, while handing the government a lower interest rate and an open checkbook at that lower rate is just, this is candy land.
And the government is showing no intent of changing anything, right? Like there's no
right.
plan on the table to fix this. There's no. Lynn Alden, she's an economist, kind of a new age one. She's got a great meme, and it's on this topic, and it just says nothing stops this train. And it's very true, because nothing stops that train. That is an enormous headwind at some point.
So we can jump back over to the white metals a little bit. The one I kind of talked the most about here when we were just taking our quick snapshot of the markets, obviously, is palladium with the most volatility. So I do kind of want to point that out. I'm real excited to see palladium taking a little jump back up. I'm less excited than if, say, palladium had gone to like a 2-to-1 ratio with platinum, which is what I was hoping would happen, and certainly still could.
To where you mean like it was half the price of platinum? Like you wanted it to where it was
2-to-1
decline.
Platinum to palladium. Yeah.
Gotcha. Okay.
Yeah, thanks for clarifying. I'd love to see it go all the way back there. But we are looking at palladium hitting the highest price of the year prior to the highs we put in last December. So it's probably pretty close, right, to like December 29th, 30th, January 2nd.
Well, yeah. I mean, it was about a month ago, I was talking about the fact it was down 12% year to date. Mm-hmm. Now it's only down 4% year to date. and,
yeah.
And platinum's
so
down
right
2.5% on the year. Yeah. So it's right there.
But we're still talking a massive swing down. 3,400 in 2022, all the way down to 800 and change 2 years later. So while I love seeing this type of move in palladium, there ain't nothing here saying turnaround or bullish. So I'm nowhere near excited yet. but it is the type of thing where we could look back in 6 months and go, yep, that was the bottom. But there's no way to know that for sure now. And kind of the same thing with silver. We keep watching silver, and Eric, you brought this up a second ago, and I think you and I are in agreement. We're still looking at a bearish trend in silver.
Yeah, until it proves otherwise, right? And
yeah, until it proves otherwise.
And again, just a big divergence from gold also that you're seeing here, right? Gold has just continued to kind of push these new all-time highs. And just from a chart perspective, remain very bullish. And yeah, I totally agree. Silver's the opposite.
Yeah.
Silver needs the economy to really turn.
Exactly.
Right? I mean, you need economic expansion. Let me ask you a naysayer question. Could this be a base that's forming? I mean, this has been a long sideways chop. Can't that also potentially be a strong signal for a resumption of a climb?
Just depends which way it breaks out of the chop.
And the underlying fundamentals. Yeah.
Right. Yeah. I mean, it makes a breakout more substantial. If you do break out to the upside, I would say that it adds validity to that. But the same is true to the downside.
Sure.
You don't want to break out of this chop to the downside either. And yeah, it, like you said, silver is much more dependent on the economy running hot than gold is.
Well, about 3 or 4 weeks ago, Miles, you put up a chart predicting, if you will, gold's price action. And you had the arrows of, hitting around 2,600, 650, seeing a little bit of a pullback and then going up to potentially 2,750. If that happens, you guys, I mean, the ratio doesn't have to go to 100, but it would be a resumption of the ratio climb that we've seen over the last 4 months. So it certainly could, but it may pull silver with it as well. If this rate cut ignites some economic activity, that's the point that I'm kind of waiting and watching for, is what type of impact does this rate cut have on silver now that it's here, now that we know that it's happening? And if they start talking about more, because the plan is supposedly they want to get down to about 3% on the Fed lending rate. I don't know why. Again, there's absolutely no reason for it. They've done a great job of cooling the inflationary fire that was burning, but if it does, it could certainly ignite the white metals. And it was interesting to me today to see platinum, palladium, and silver and gold, all four do the same thing. Look at all four of those charts. Just like the other indices, platinum and palladium and silver did the same thing rather than moving counter trend.
Yeah, I think you guys are right as far as silver goes. Certainly lower interest rate assumes increased economic activity because of increased spending capability. So sure, from a industrial metal standpoint, or discussions about things like new Samsung EV car batteries. There's always a song and dance or a sales pitch out there that kind of argues for it. My argument is this: if that were the only underlying factor, then you would see silver behave more in line with things like copper and oil during economic booms, and it tends to not.
Right back to Eric's point.
Yeah, during economic booms, when things are going really well, why the heck would you buy gold? And if silver is sitting down where gold is, when frankly you should be buying it, but nobody is interested in it, when silver is sitting down where gold is, it's less driven by economics than it is by some of the fundamental or underlying aspects, in my opinion. So why doesn't it respond along with gold as gold is moving up? And to be perfectly honest, I think it's because it's less enticing as gold. So I threw out the word or when we were talking about it, because I think there is an or here. Either silver can go up along with other precious metals going up from an economic standpoint. And we saw how that can happen with palladium. So we know it can happen. Palladium went to $3,300 during an economic push. So it can happen in the precious metals. Why didn't silver? Because I think it actually is still more tied to gold than it is a standalone industrial metal on its own. And honestly, I think silver is the thing that people get interested in. When the average person gets interested in gold, they're a day late and a dollar short coming into the market, and gold has already achieved a price that they can't afford. So they start looking around for alternatives, and silver is the most apparent alternative. So I think it can be either of those things, and personally, I believe the latter holds way more strength than the former does.
I think that that's all fair, Miles. I think that's part of the puzzle and the volatility that's included in silver, and that is exactly why we use silver for the ratio alone. Because regardless of any of these outcomes, if we get the slowdown economically and silver does decrease at a faster rate than gold, and that spike does happen to 100 to 1, we don't necessarily need to know why, but we do know that 100 to 1 is a very significant outlier event. That is a time to make a move. And history shows us that when that ratio compresses, it pays handsome dividends. So we'll keep trying to figure out the why, but I hate saying it doesn't really matter, but it kind of doesn't matter.
No,
so
I'm sitting here smiling,
beauty,
man.
Right?
It makes no difference. It's fun to figure out, but give me 100 to 1 silver. I couldn't care less, man. I'll buy it all day long.
You just got to take advantage of those outliers when they do play out. And again, we're not being lazy and not trying to figure out why it's happening. We are, but it's a darn hard thing to find out.
So that's going to do it this week for Golden Rule Radio. As always, we appreciate you stopping by. Hit the subscribe button, ring the bell, and head on over to Facebook, where we can be found at McIlvaney Financial. We're also on Twitter at ICA Gold, and you can find us on our website at McIlvaney.com. If you'd like to discuss your personal portfolio with one of the advisors here at McIlvaney Precious Metals, we can be reached at 800-525-9556. Thanks for listening and have a great week.